Good morning and welcome to this special edition of our fourth quarter Guide to the Markets webinar. I'm Ty Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And joining us this morning from Boston is my boss and our Chief Global Strategist, Dr. David Kelly. Because of all the things that could have happened in the fourth quarter, I'm delighted to have David with me this morning and share with us some of the key observations and insights from the U.S., whether it's the U.S. economy, whether it's the Federal Reserve's policy outlook, as well as, of course, very importantly, with less than 1 month to go, the U.S. presidential and congressional elections. So, David, thanks for joining us this morning.
Very, very glad to be here.
Just a couple of advertisement. We always have the podcast for you. We have the weekly On the Minds of Investors publications, but at the same time, we have On the Invest Minds, which is available on either Apple Podcasts, Spotify, or our website, where you can get our latest thoughts on the market. So the last 2 weeks, I've covered what's happening in China, the market outlook, but obviously going forward, in the next few weeks, we have a lot more coming from both the stateside as well as coming out of Asia. So if you want to catch our latest thoughts and insights, that's where you can find them. And of course, the daily guide to the markets, we highlighted some of the key, most frequently updated slides or frequently requested slides that we update on a daily basis. And all of that is available on the screen right now on the QR code. So let's get going. So David, I think let's start with the macro big picture of the US. I think from the start of August up to this point, which seems like a lifetime ago, but a lot's happened. We've swung from fear of spike in unemployment rates, potential recessions in the US, and then last Friday, we had the really strong job numbers for September. And again, market expectations on the Fed, which we'll come back to in just a moment, that's been moving all over the place. So what is your latest assessment of the US economy? Or what is the threat or the risk of a recession over the next 12 to 18 months?
Yeah, well, first of all, very pleased to obviously be on this webcast. I think that's a good question to start with. Now, we're going to use some slides here, and I hope we can pull up a slide I have here on the cyclical sectors of the U.S. economy. When we think about recession in the United States, the right way to think about this is, look, the population grows every year or the working age population grows by maybe 0.5%. The productivity growth rate's about 1.5%. So in a normal year, you'll get about 2% growth anyway. And the real question is, what is it going to be that's going to cause consumers or businesses to pull back enough to put you in recession? So I'm hoping you can see this chart here, but on this chart, we show the cyclical sectors of the U.S. economy. So home building, business fixed investment, vehicle sales are three of the most important. And the thing I'd point out is, we go back quite a long time in all of these. If you look at home building, we're spending a little over 4% of our GDP on home building, but that's actually below its long-term average. There's no evidence that there's too much home building going on in the United States, or there are too many houses. That's not going to cause a recession. If you look at business investment spending, it's fairly strong, particularly in AI and capital spending on building new manufacturing facilities. But overall, as a share of the economy, it seems to be pretty much under control. It's not as overbearing or overextended as it was before the dot-com bubble. If you look at consumers, one of the things that we track very closely are auto sales, and auto sales they've recovered. They're fairly strong, but they're still not as strong as they were before in the average for the 5 years before the pandemic. So nobody could say that they are booming or exuberant vehicle sales. And then if you look at delinquencies, they're rising, but they're still well below levels that we saw after the great financial crisis. And one of the things that's happened in the United States that I think is very important is we've seen an enormous surge in wealth. In fact, from 2019 to today, if you look back over the last 5 years, we estimate that the total wealth of American households grew by $50.1 trillion. That's both home equity going up and it is stock market appreciation. But that does act to insulate a lot of consumers. About 2/3 of American consumers own their homes. They're by far the most important consumers in terms of actual overall spending in the economy. And, if you've got a few $100,000 in home equity, you're not going to default on your property. You're going to have some way. You can probably of paying your bills. If your parents are doing well, if your relatives are all doing well, it's easier to avoid delinquencies. So we're seeing some stress, not surprisingly, in terms of some rising delinquencies, but it's nothing like we saw before the great financial crisis. So overall, from a demand side, when we look at consumer spending, we look at investment spending, we look at housing, there's nothing that's going to push this economy into recession. The other way of looking at this is from the supply side. So the next chart I want to mention is a chart which looks at unemployment and labor demand. Looking at, first of all, at the unemployment rate. The unemployment rate for the month of September, we actually show August in the chart here, but we just got data on Friday for the month of September. The unemployment rate came in at 4.1%. So it's come down a little bit. It's hit 4.3 now. It's come down 4.241. So that's actually a pretty good number. The unemployment rate in the United States, the Federal Reserve thinks that 4.1 or 4.2% is about full employment. We've essentially been there at or below that number since December of 2021. So we've had this long period of basically full employment. And yet what we've seen is two things that are really important. First, on the right-hand side of the page, we've seen job openings come down as we've been able to fill jobs. We hit 12 million job openings back in March of 2022. We're now down to about 8 million job openings at the end of August. Now, it's still higher than it was any time before the pandemic, but it's within shouting distance of a normal level. So that's normalization. But the other thing that's happened is wage growth has been very suppressed. So we've seen wage growth come down from, it peaked at 7% back in March of 2022. Now it's down to 3.9% year over year. And what's happening is, despite occasional loud noises from a strike in the United States, there are very few strikes. There was a dock worker strike which lasted about 2 days. But apart from that, we have no more than 30 major strikes a year. We're actually going to have fewer strikes this year than we had last year. Workers are not particularly strident, or they're not militant. They try to, they're willing to accept pretty low wage gains. And so we've seen wage growth come down. Workers are willing to accept it. They know that inflation's coming down, and that's helping hold down inflation. So overall, the other thing I think I have to mention is on the labor supply side, we're seeing a lot of immigration. And that's been going on for the last few years. It is beginning to die down a little bit now, but we've had something like 3 million people come across the southern border in the course of 2023. That allows the U.S. to fill a lot of jobs in places like retail and restaurant jobs and in landscaping jobs. So they're not all high-wage jobs, but we're seeing job growth partly because of immigrants coming in, both at an unskilled level across the southern border, and then people who more traditionally fill out visa applications at embassies all around the world are really bringing skills into the United States. So it's got dynamic labor supply. It's keeping the economy going. So I don't think there's anything within the economy that will put the U.S. economy in recession. If the U.S. economy enters recession, it's going to be because it gets hit by a shock from outside. And I think that's very important to realize. Because sometimes people ask me, is this early cycle or mid-cycle or late cycle? The truth is we're kind of post-cycle. This is an economy that is not going to be put into recession by normal cyclical forces of the Fed raising rates too much and that's slowing the economy down too much. We're kind of past that. So overall, it looks pretty good. I think we've still got steady growth until some shock puts this economy in recession.
So, David, I think that's a really important point, and that is, I think maybe a few months ago we were worried about high rates potentially putting more pressure on the economy and forcing that into recession. But obviously, the attitude or the perspective of the Federal Reserve has changed quite significantly in the past 3 months. Instead of focusing on inflation, they're now more worried about or more caring about the job market and the broader health of the economy. So, is inflation truly defeated? We've seen energy prices spike up a little bit recently because of tension in the Middle East. Is inflation truly beaten? And therefore, what's the Fed going to do, both in the next couple of meetings, but also extending that into 2025?
Yes, I think if you look at the next chart, I think inflation is essentially beaten in the United States. I don't think, although inflation got high, I don't really ever think it was going to be permanent. I never thought it was going to be permanent. What happened is, if you go back, really from the last big inflation surge in the United States occurred in the 1970s and early 1980s. And from about 1981 on, the inflation rate has been coming down very steadily. And it came down all the way from the early 1980s to the pandemic, essentially. And that's because of long-term forces. We don't have these strong trade unions, so that's suppressing wage growth. We've got a very unequal distribution of income. That means money is going to buying stocks and bonds, but not buying goods and services. That holds down inflation. Information technology itself makes it easier for buyers to find deals. That holds down inflation. So I don't think the US is very inflation prone. We did have a surge in inflation because of the pandemic and an extraordinary fiscal response and putting money into the hands of lower and middle income households, and they spent the money and that pushed up the price of stuff, particularly when you had supply chain issues. And that was made worse by Vladimir Putin and what happened with Ukraine. But we never got to a situation where Americans really believed that inflation was going to be much higher in the future. And we never got to a position where workers felt they could really demand much bigger wage increases than the actual inflation they're seeing. So I don't really think there was ever a threat of inflation getting embedded in the US economy. But what has happened is, over the last year in particular, we've seen supply chain issues get fixed. So there isn't really a core goods problem. There isn't a food problem. There isn't a problem with energy for the most part. We have seen a small or minor increase, I would say, increase in oil prices in the last few weeks. But gasoline prices have come down quite considerably. So energy is still down, or as experienced by consumers, is down year over year. So in August, the CPI number came in at 2.5% year over year. The personal consumption deflator, which is the number the Federal Reserve looks at, came in at 2.2% year over year. Now, on Thursday, US time, we're going to get a new CPI report for the month of September. I think that will show either 2.3% or 2.4% year over year. And if it shows 2.3%, that probably means the consumption deflation will come in at 2.0% year over year for the month of September. And that finally hits the Fed's target. So when I look at what the Federal Reserve did in September, I don't think they really should have gone 50 basis points. I think they should have gone 25 basis points. But I really think they're motivated by saying, look, the economy's healthy, but monetary policy is tight. There's no reason, if the economy is on the right path, to keep a tight monetary policy in place. So we're going to bring it gradually back to normal. And although they started with 50 basis points, if you listen to Jerome Powell earlier on last week, he's talking about the next few rate cuts will be smaller. So I do think that we should probably just sort of follow the Fed's dots here and believe them when they say that they're going to try and bring rates down gradually. Unless the economy gets hit by some shock, I think that's what they'll try and do.
So let me just follow up with that comment. So I do agree with you that I think in September I also thought that 25 was more appropriate, but obviously the Fed moved 50. If you look at the futures market, is pricing in more than 2 times 25 basis points cut before the end of the year. And at the same time, if you look at the end of 2025, is looking at around 3% in terms of policy rates versus the Fed's own projection or median projection of 3.4. So would you say that the market is probably a bit too aggressive in the short term over the November-December meeting, but is the Fed being a bit too conservative on the pace of rate cuts in 2025?
I think the Federal Reserve is accurately reflecting what they think right now. But I think when you look at the market, you have to be careful, because there are really sort of 2 major possibilities here. One, because I don't believe that inflation is going to take off again, and I don't think anybody else does either. So then the real question is, the economy continues to grow slowly but gradually, and it's fine, or the economy trips up on something and ends up in recession. But if you're investing in the futures market, the futures market price will essentially be an average of those two possibilities. If you have a recession, the Federal Reserve is going to cut very aggressively, much more aggressively than 150 basis points over the space of the next 15 months. And because of that, I think that it's biasing all these numbers down. So I don't really think the market, the average person in the market thinks the Federal Reserve will cut 3 times this year and maybe 6 times next year. I don't think that's what they think. I think it's an average of they could either follow their dots if we don't have a recession, or if we have a recession, they're going to be much more aggressive. And that gives you a market forecast which looks more dovish than the Federal Reserve. But I think it just reflects people hedging their bets against the possibility that something puts us in recession.
Great. Thanks, David. So maybe just quickly summarize the view on the macroeconomy and the Fed. Essentially, the US economy is still in reasonably good shape. It's gone from arguably quite a hot running economy to something more moderate but more sustainable. Inflation is under control, and we should expect inflation to gradually come down towards the Fed's target, and which means that the Federal Reserve is able to, again, take a gradual approach in cutting rates. So again, I think it's exactly what we've been telling a lot of our APAC clients in the last 12 months, is that we are pretty much having a soft landing or even a no landing scenario alongside with the Fed cut, which historically has been quite beneficial to both equities as well as fixed income. I think that could well be, again, the theme as we approach 2025. Let's change track towards the elections. If you look at a lot of the polls right now, especially in swing states, I think candidates, former President Trump and Vice President Harris, in many of these swing states, they are very, very close within the margin of error. What's your take on the elections, and maybe not just on the presidential, but also the congressional race? What should our investors in Asia Pacific be watching out for?
Well, I think if, to cut to sort of my conclusion here, the most important thing to think about is the fact that we may well end up with divided government in the United States after the election. So I'm going to talk about the 3 elections basically going on that matter, the presidency, the Senate, and the House. On the presidency, as you said, Ty, it's all about the swing states. There are actually 7 swing states where the vote is within, maybe 1 or 2 or 3%, according to the polls. And the polls themselves are not very reliable. It's very difficult to poll people properly these days. And those states are Wisconsin, Michigan, Pennsylvania, Arizona, Nevada, Georgia, and North Carolina. And the whole US election is basically going on in those 7 states. It's a weird system because everybody else, if you're in Texas or New York or California, you're basically disenfranchised. Nobody cares because they know which way those states are going to go. So it's down to these 7 states. And the polling right now is, as you said, very, very tight. If Kamala Harris wins Wisconsin, Michigan, and Pennsylvania, she will win the presidency. But the Wisconsin and Michigan look like they are marginally leaning towards her. Pennsylvania is just way, way, way too close to call. And I think it could be that way all up until election night. Now, on election night, to be honest, I think the votes will be counted slowly in Pennsylvania, and it may be a few days before we know exactly how this is going to turn out. I do think that there are enough political scientists who've looked at how these different precincts have voted in the last 2 elections to be so that I think we will actually have a good sense of how this is going at some stage the day after the election, but we may not get an official winner on the presidency announced for quite a few days. And Ty, you and I are going to do a call. We're bravely doing a call a few hours after the polls close, so we'll see just how much we know.
I was going to just again do that advertising where on the 6th of November, David's kindly offered to do this with us at 1:30 p.m. Hong Kong, Singapore time, which I think it's 1:30 or 2:30.
Yeah, 1:30 minutes,
US
pretty much
Eastern time.
one of those.
So it's going to be hot off the press. So again, if you want to dial into that call, you're obviously very welcome to, and please tell your colleagues and friends who may be interested. But the day literally after the elections, we are going to be hosting another call with David joining us, just to really, we may not get a full results, but I think we should have a pretty good idea of where things are going. But well, we'll get there when we get there. But David, back to you.
Yeah, let me continue. So that we have a map in our deck here where we're showing the different states and the list of swing states over on the right. And as I said, Pennsylvania is too close to call, so the whole election is too close to call. But let's turn to the Senate and then the House. So on the Senate side, the Republicans have a significant advantage. In order for the Democrats have a 51-49 lead in the Senate right now. But they are going to lose a seat automatically in West Virginia with the retirement of Joe Manchin. That gives you 50-50 because the Republicans will pick up that seat. The only way the Democrats can even hold 50-50 is if they hold a Senate seat in Montana, which are right now trailing by any polls that have come out of Montana, and Montana is a very Republican country. So that's it. I would say it is unlikely that the Democrats will hold the Senate. But it's just possible. If it is a 50-50 tie in the Senate, then the U.S. vice president gets to cast the tie-breaking votes. So in theory, if Kamala Harris was successful in the presidential election and the Democrats managed to hold that seat in Montana, then they control the Senate. But the odds are stacked against them. Conversely, though, in the House, the odds are actually stacked in favor of the Democrats. So if you look at the best way of looking at this is we have midterm elections. Members of the House of Representatives are just elected for 2-year terms. And so we can look at the results just from 2022, 2 years ago. And the Republicans did win that election. But in terms of seats, they ended up with 222 House seats to 213 for the Democrats. So it was close, just 11 seats in it. If you look, however, at the closest contests on both sides, the popular vote in the congressional elections was 50% for the Republicans and 47.3% for the Democrats. If you just took 0.5% out of the Republican column and put it in the Democratic column, the Democrats would have won that election by 220 to 215. If you take 1% out of the Republican column, so they just get 49, and you put it in the Democratic column, so they get 48.3, you another 2 seats shift. So the Democrats would then win 222 to 213. And I know this sounds somewhat arcane and nerdy, but that's how close it is. It does seem that if you have an election, it's quite possible you could have an election in which Kamala Harris wins the national vote and the Democrats win a majority of the votes in the House of Representatives, but they lose the they lose the Senate and they lose the White House. But in that scenario, they would take the House of Representatives. And so that's why, getting back to where I started, it's all too close to call. Nobody should make a bet on this outcome right now. But based on what we're seeing, if the election were held today, it probably would end up a divided government with the Republicans controlling the Senate, the Democrats controlling the House, and the White House an absolute toss-up. And so I think that when we think about the next few years, the most likely scenario is you're going to get less change than people would expect, precisely because we'll have divided government.
So, Dave, on that note, I think it's really important, I think, to share the relevance of the Congress in the context. Because if I look at, for example, on the next page, when it comes to what both Vice President Harris and former President Trump, on the campaign trail, what they are suggesting, what they're pledging in terms of their policy directions, some of which will need Congress support, some of which may be executed via the executive order. Maybe you can share with me or share with us a little bit in terms of what you think are the policy stance by the two candidates, and which of these could be blocked or at least diluted if there were going to be a divided government?
Okay, so on the policy page in our deck, we have just a very short summary of these policy proposals. I don't think that all these policy proposals they're making on the campaign trail should be taken too seriously. So, for example, former President Trump has promised to eliminate taxes on overtime, eliminate taxes on Social Security, eliminate eliminate taxes on tips for restaurant workers, none of which he proposes to pay for. I don't think he really means it seriously, but it does. It does. It is important to some swing voters. What would actually happen is if you have divided government and Donald Trump becomes president again, the first thing is I think that all the tax cuts in the Tax Cut and Jobs Act of 2017 get extended. Now the individual tax cuts are on track to expire at the end of 2025. Well, they'd get extended. And I think that even in divided government, it would be hard for a Congress to oppose the president if Donald Trump gets elected to oppose him in doing that. But other tax changes, apart from the extension of those tax cuts, if you want to do other things like cut the corporate income tax rate or change capital gains taxes, it would have to go through Congress. And if it's a divided Congress, Democrats are not going to give them a free pass to do that. And I think that's true for a lot of policies. I think it's true for on tax, on energy policy, on defense policy, on healthcare policy. All of those things are things that a divided Congress can prevent a president from doing. But there's some areas where he could have an effect. One of them is on immigration. The United States needs immigration reform, and that probably, that would be less likely to happen if Donald Trump is elected president because the Democrats just won't want to compromise with him on it. But he can achieve a certain amount through executive order because they can, implement various policies on the southern border at the president's executive order. So I think that's important. I think on regulation also, the president's got some discretion in terms of how he tells various departments to regulate. But the big thing the thing that he could do if Donald Trump becomes president again without congressional approval is tariffs and trade, because we saw this in his first term. He didn't have to push a trade bill through Congress at all. He could simply say, well, it's a national emergency or requirement or whatever, so we're going to put tariffs here, tariffs there. And over the years, Congress has ceded a lot of responsibility to the president on trade policy. So I think the biggest thing to think about is, would he impose a 10% tariff on goods and services coming from all over the world and a 60% tariff on Chinese goods and services if he were elected? I think he would get pushback from Republicans in Congress, but he might not care about that because he would say, well, everybody knew I was going to raise these tariffs. They voted for me. So tough cheese. And so I think that's the one thing I think we have to watch. On healthcare, I don't think they're going to do anything on healthcare. I think the Affordable Care Act, or otherwise known as Obamacare, is pretty popular. I think it's going to stay in place. And then the last thing on this page we mentioned is monetary policy. I think that certainly if Vice President Harris is elected, I think she'll just continue the policy of most American presidents of, the Federal Reserve does their thing and we're not going to interfere. If former President Trump becomes president again, I think he will try to push the Federal Reserve to behave in a certain way, but I think they will push back. I don't think he's going to achieve that change, and he has only limited authority to fire members of the Federal Reserve. He actually can't fire them off the Board of Governors, I believe. He can fire somebody as the chairman of the Federal Reserve, but I'm not sure that he will want to pick a fight on that, because if you remember back in 2017, 2018, he gave Jay Powell a very tough time because he wasn't easing monetary policy enough. The problem is that people in America are now equally scared about inflation as recession. So even if Donald Trump wanted to get the Federal Reserve to obey his requests, he might not be able to decide what it is that he wanted them to do. Does he want them to be very easy and cause inflation to pick up, or does he want them to be very tough and run the risk of recession? And I'm not sure where he stands on that, but I would tend to believe he's more bluff and bluster on that. I don't expect that we'd see a major change in control of the Federal Reserve.
Great, thanks, David. So look, I think, again, just to briefly summarize on the political front, frankly, the elections right now, whether it's the presidential or the Senate or the House, is a really close call. We still have a few weeks to go and a lot can happen. We have a hurricane coming to Florida. We have, a lot of economic data still to come through. So watch that space. But in terms of policies, what politicians say on the campaign trail and what they implement in office can be quite different. And of course, there could be constraints when they do come into power, as we've seen with the new Japanese prime minister. He was talking about potentially raising taxes and a number of other fiscal austerities. But as soon as he comes into power, a lot of those campaign pledges have been U-turned. So again, I think we need to be quite clear on the responsibilities and the power that was provided to the president and what's required cooperation from the Congress. Now, let's bring everything back to investing. I think maybe still continuing with this theme of elections and politics. David, what's your key thoughts or recommendations to our clients in the US when they look at the elections very close to their hearts and their investment strategies? How will the two connect, or should they be connected in any way?
No, I think they should be very careful not to draw too much of an implication from politics for what it means for investing. And I think a perfect example of this, we have one of our charts in our election deck, looks at what happened to green energy stocks and fossil fuel stocks under the Trump administration and under the Biden administration. Now, Donald Trump, as you know, tends to favor fossil fuel energy and is not that worried about global warming, whereas Joe Biden and the Democrats are much more worried about global warming and favor green transition energy. But over the course of Donald Trump's term, fossil fuel energy actually companies underperformed and green energy companies performed very well. Then when Joe Biden becomes president, the opposite happens. Fossil fuel companies do better and green energy companies do worse. And I think it's a real message to us to just be careful about assuming that just because somebody favors a particular sector in the economy, that that's going to be good for the companies in that economy, right, in that sector. So I think that's one thing. I think more broadly, I would say that that it's not really about elections. I mean, everybody gets very interested and excited and angry about elections here, but generally speaking, it is the behavior of the economy that matters. So when we look at the stock markets, you have in your Asia guide, like we do in the US guide, a chart which shows index concentration. You can see where the overall S&P 500 is in terms of valuation, but you can see where the top 10 stocks are. And there is a problem with just very high valuations among those top 10 stocks. I don't necessarily think that's going to change overnight. I think what's going to happen is we will tend to sort of play this soft landing scenario out for as long as it lasts. That could still mean more money going towards mega cap growth stocks, less money going to small cap stocks, more money going into US stocks, less money going into international stocks. That could continue for a while. But I do want to emphasize it from an investment perspective. Just because that could happen doesn't mean that that it will happen. And there's eventually there will be some shock that puts the economy into recession. You don't know it, and I don't know what that is either. But that's the history of the 21st century, whether it was Lehman Brothers or 9/11 or the pandemic. Something comes along out of left field, puts us in recession. When we have that, the stocks that are most expensive are the ones that are most vulnerable. And so I think that's why people ought to try and lean against sort of index concentration here and try and look at a more active approach to trying to invest in US equities. And then one other thing we put in this deck, or I put in this deck, was so we have a chart looking at the top 10 stocks and everything else, but we also look at, okay, the Fed's begun to cut. What happens to the stock market and the bond market? And almost universally, the bond market does well. It's not huge, but the bond market generally gets up. We show that on the right-hand side of this page. But for the stock market, it really depends upon the economy. If the Fed starts cutting rates and the economy keeps on growing, stock market tends to do very well. But what we saw in 2000 and what we saw in 2008 is if the economy falls off the rails, stocks are going to do poorly, whatever the Fed does. And then, finally, in terms of valuations, I know you want to say a few words about what's going on in China, but when we look at global valuations in the Asia Guide to the Markets, India is obviously expensive, but apart from India, the US is the most expensive. Again, it speaks to, yes, there's a lot of things are going right in the US economy, but I think people ought to be diversified around the world. That's certainly my message to US investors. I think it's a good message for investors in general, because the US has done very well, but valuations have gone up. They're high relative to the rest of the world, and it just makes sense not to have all your eggs in US basket, particularly with an election coming up, with all the potential geopolitical uncertainties. So that's kind of how we see things.
No, thanks, Dave. I think the point about the Fed is really important, because the analogy I've been using for the past couple of weeks is the Fed just watering the plants, or are they fighting a fire with a fire hose? Because if they're just watering the plants, the economy is doing okay, they're just gently providing a bit more liquidity to the system, then as the chart you showed earlier, equities and fixed income can both do well and outperform cash. But if there's a fire and they have to really fight the fire with a huge amount of liquidity, then historically that's not been great for risk assets or equities, even though high quality fixed income like government bonds, investment grade corporate debt, that tends to perform better. So I think, again, the distinction has been highlighted throughout 2024 of the reasons behind the Fed cutting rates. That to me is really crucial. So I'm going to give you a 5-minute break. Yeah.
No, just one last thing I want to say on that. I just want to re-emphasize that, because we get a lot of good data on the US economy, lots of data on housing, unemployment claims, industrial production, private sector surveys, the PMI indices. So if you look at the whole mosaic of the US economy, there's nothing that says the US economy is dipping into recession right now. It's just not there. Anyway, I'll turn it back to you.
Look, David, I'm going to give you a 3-minute break. I'm going to quickly touch on China. So on September 24th, we've had a flurry of policies being announced by the People's Bank of China, by the financial regulator, as well as the securities regulator. Essentially, these policies are targeting the consumption side of things, the effective demand, as they call it, the property market, as well as some, I would say, fairly innovative policies on the stock market. And then same week, we had a Politburo meeting where the top decision-making body of the government, again, re-emphasizing the importance of supporting the economy. So I think that particular week gave investors a new perspective of Beijing's policymaking, where in the past, frankly, if you look at a lot of the measures announced on September 24th, they weren't new. Rate cuts, reserve requirement cuts, more spending on the economy, that's not new. But the fact that they were put together in a package, they were more coordinated, I think that was different. It shows a sense of urgency from the authorities that they do need to fix, or at least provide a bit more support to the economy. Then we went on to the National Day Golden Week holiday. And then yesterday, there was a meeting with the National Development and Reform Commission. There was very high expectations of more policy stimulus to be announced. But frankly, I listened to it live, and it was more of just a reiteration of the policies combination that was announced before the holiday. So I think the market was somewhat disappointed by the lack of fresh news or detailed policy implementations. And as we saw both in the Hong Kong market yesterday, as well as the China market, despite starting the day at about 10% higher for CSI 300, it ended the day only about 5.5%, 6% higher. So I think from that perspective, there are a couple of key takeaways at this point. Number one, I think markets and investors, they are still watching out for two things. One is the effectiveness of these policies. We did see some high-frequency data from the Golden Week holiday already. We saw, for example, flight traffic, passenger traffic that continues to grow, but per capita spending is still down. So the long-standing, consumption, being more frugal, being a bit more smarter on spending, that continues. If you look at areas such as electrical home appliances and cars, where they are getting more fiscal support from the government, there are more subsidies, there are more spending coupons, they're doing okay. So I think all in all, the market rally of the past 2 or 3 weeks have yet to really fully convince investors that the Chinese economy is turning around. But the second point then is whether we'll see more follow through for the policy. For example, if you look at this, the chart on the screen right now, in terms of the property sector, there's still huge inventory overhang when it comes to the markets, whether it's in the the tier 1 cities or tier 2 cities. The smaller cities are clearly having a much bigger issue. Could we see more fiscal resources being spent on soaking up these inventory? That to me is going to be another key factor to watch out for. At the same time, local governments, because of poor land sales, they don't have enough revenue and resources to support the local economy. Could the central government, again, raise debt or raise bonds on their behalf and then transfer that fiscal resources to the local government in order for them to do more, whether it's spending coupon or infrastructure investment? I think all of that is going to be closely monitored by investors around the world. I think the other point to bear in mind is, if you look at the Chinese markets at an index level, frankly, well, except for the last 2 weeks, which have done phenomenally well, but for the longest of times, the Chinese market index, whether it's in Hong Kong or in China, frankly, the performance has been flat or disappointing. But if you look underneath that, or a couple of levels below that index, what you find is, actually for the last 18 months, a lot of more defensive sectors, banks or defensive stocks, banks, telecommunication, energy companies, state-owned companies with high dividend characteristics, they actually did pretty well. Where things have struggled is more the more cyclical sectors, for example, e-commerce, consumer discretionaries, retailers, because of that more frugal, more conservative spending pattern by Chinese consumers. Clearly, they have had a bigger challenge in terms of growing their sales. But if we were in an environment of, a cyclical turnaround that might come later this quarter or in 2025, you could argue that there may be some room for rotation from the defensive, the high dividend stocks back towards the more pro-growth or more pro-cyclical sector. So again, when you're looking at China, the alpha generation opportunity to me is interesting, and to me is actually more important than the overall beta opportunity, because frankly, again, if you look back to the track records of some of the high dividend stocks in the past 18 months, that they did really well up to the point of around late August, early September, before the stimulus round came through. The big four state-owned banks actually generated 20-25% return year to date, or up to that point. So again, there are opportunities in China. You just have to look in the right places, and again, adjust to the cyclical changes that we may see over the course of next several quarters. So overall, I think investors are still waiting for more, both in terms of evidence of the economic cycle bottoming out, and also a continuation of fiscal and further monetary policy easing and support that could bring the economy back to a stronger footing. But ultimately, there are still long-standing issues: the property market, the deleveraging process, business confidence on government's role in the economy. I think all of that will require more time for things to turn around. So it's not just about what happened in the last 2 weeks or what's going to happen in the next 2 weeks. It's going to be about over the next several months and quarters whether we could see a fundamental turnaround in the Chinese economy. Thank you so much for your time, and hopefully that for everyone is an insightful hour of your time well spent. As I mentioned earlier, we do have the post-election call in Asia time. That's going to be in the afternoon of November 6th. So please join us, and David will be here again to share with us his immediate thoughts of the election results. And thanks for your time again, and have a great day.
Thank you.
Thank you, David.
Thanks.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.